The signal is already flashing, and it's not subtle. 1 out of every 20 borrowers with an auto loan is now more than 90 days behind, and that number alone tells you something inside the system is starting to break. This isn't a minor slowdown or a temporary disruption, it's the early stage of a structural fracture that is spreading quietly beneath the surface. And what makes this even more dangerous is that the damage you're seeing right now is only the visible layer, because underneath, the pressure is building in ways that the system is actively trying to hide. At the same time that delinquencies are rising, banks are continuing to push out loans that are fundamentally unstable. Right now, 50% of all used car loans are being written at more than 120% of the actual value of the vehicle, which means the loss is embedded from the moment the deal is signed. The borrower starts underwater, and there is no realistic path back to balance. But the system keeps moving forward anyway, and the reason is simple. People can't afford these cars under normal loan structures anymore. Instead of lowering prices or tightening lending standards, banks are stretching loan terms out to 84 months, turning what used to be a 5 or 6 year obligation into something that now spans 7 years or more. This doesn't fix affordability, it only disguises it by shrinking the monthly payment while expanding the long-term burden. That's where the illusion begins, and it's also where it starts to break. Subprime borrowers, already under pressure, are now defaulting at rates close to 7% for loans that are more than 60 days past due. These numbers are already worse than what was seen during 2008, but even they don't fully capture what's happening, because the system isn't processing the defaults the way it normally would. There's a growing backlog of vehicles that should have already been repossessed, but they haven't been. Not because borrowers are suddenly recovering, but because there aren't enough repo drivers to physically retrieve the cars. The system is clogged, and that clog is masking the true scale of the problem. At the same time, lenders are deliberately delaying the recognition of these losses through what is now being called extend and pretend. Instead of repossessing vehicles when borrowers fall behind, banks are extending loan terms, restructuring payments, and maintaining the appearance that everything is still functioning. Month after month, the problem is pushed forward, but it never actually disappears. It accumulates. And eventually, that accumulation reaches a point where it can no longer be contained. When that happens, what looks like a sudden crisis will actually be the release of pressure that has been building for a long time. The data already hints at how far this has gone. Right now, 5.2% of all auto loan debt is more than 90 days delinquent, a level that should not exist under normal conditions because loans that reach that stage are supposed to trigger repossession. The fact that this percentage continues to grow shows that the system is actively delaying its own corrective mechanisms. And while that delay may temporarily stabilize the surface, it makes the underlying collapse far more severe when it finally arrives. As if that weren't enough, another layer of instability is now spreading through the system in the form of fraud. Approximately 1.7% of all auto loan applications are now linked to credit washing, which means that borrowers are actively manipulating their credit profiles to qualify for loans they would otherwise be denied. What makes this especially dangerous is how easy it has become. With the help of AI, individuals can flood credit bureaus with disputes, temporarily removing negative marks like missed payments or previous repossessions. During that window, their credit scores appear significantly higher than they actually are, allowing them to secure loans under false pretenses. By the time the system corrects the error, the loan has already been issued, and in many cases the borrower has no intention of making payments. This shifts the problem from simple financial stress into systemic contamination. Banks are no longer just dealing with borrowers who are struggling, they are holding loans that were fundamentally misrepresented from the start, and yet the system continues to generate more of these loans because the incentive structure hasn't changed. Banks still rely on loan origination for revenue, so they continue to extend credit even as the quality of that credit deteriorates. The deeper issue becomes clear when you look at the nature of the asset itself. Cars depreciate rapidly, especially in the early years. A vehicle that costs tens of thousands of dollars can lose a significant portion of its value in a very short time. When that depreciation is combined with long loan terms and high loan-to-value ratios, negative equity becomes unavoidable. Borrowers find themselves owing far more than the car is worth, and the longer the loan lasts, the wider that gap becomes. Payments in the early years go mostly toward interest, doing little to reduce the principal, while the car's value continues to fall. This creates a trap that becomes most dangerous at a specific point in time. Around 42 months into a loan, the likelihood of default increases sharply. And if you look back to what was happening 42 months ago, you find the peak of inflated car prices, when supply shortages and market adjustments pushed prices far above normal levels. Vehicles that had a listed price of $50,000 were being sold for $70,000 or more, and buyers accepted those terms because they had limited options. Now, those same vehicles are worth significantly less, often around $30,000 to $35,000, while the borrowers still owe close to the original inflated amount. This is where the system begins to fail in a visible way. Those borrowers are now entering the highest risk period of their loans, carrying extreme negative equity with no viable way out. They cannot sell the car without taking a massive loss, and they cannot refinance because the loan exceeds the value of the asset. The only remaining option for many is default, and that is exactly what is beginning to happen. At the same time, the conditions that created this situation have not been corrected. Loan-to-value ratios remain elevated, averaging around 120% for used vehicles, which means the cycle is continuing. Banks are still enabling high prices by financing amounts that exceed the actual value of the cars, and as long as that continues, prices cannot adjust downward. The system feeds itself, maintaining the illusion of stability while increasing the underlying risk. Institutions within the system are fully aware of what is coming. They can see the rising delinquencies, the missed payments, and the growing likelihood of default across their portfolios. In response, they are increasing their loan loss provisions, setting aside capital to absorb the impact of future losses. This is not a preventative measure, it is a defensive one. It reflects an expectation that significant damage is already on the way. When repossessions eventually accelerate, the losses will not be limited to unpaid balances. Many of the vehicles that are recovered will be in poor condition, reducing their resale value and increasing the financial hit to lenders. Losses of $10,000 to $15,000 per vehicle are not uncommon in these situations, and when multiplied across a large volume of defaults, the total impact becomes substantial. This is the point where the problem extends beyond individual borrowers and into the broader financial system. The auto loan market is deeply connected to consumer credit, banking stability, and overall economic activity. As losses increase and lending tightens, the effects begin to ripple outward, affecting liquidity and reducing the ability of consumers to access credit. What once appeared to be a stable and functioning system begins to reveal itself as something far more fragile. The growth that was observed was not built on sustainable fundamentals, but on extended terms, inflated valuations, and increasingly risky lending practices. The stability was not real, it was constructed. And now, as multiple pressure points converge at the same time, the system is entering a phase where those underlying weaknesses can no longer be ignored. Rising defaults, delayed repossessions, increasing fraud, and expanding negative equity are all interacting, amplifying each other in ways that make the outcome more severe. The most critical detail, however, is timing. The largest wave of risk, linked to the peak of inflated car prices, is only now entering the period where defaults are most likely. This means that the current data does not represent the peak of the crisis, but the beginning of its escalation. The backlog of repossessions will eventually clear, the delayed losses will be recognized, and the full scale of the problem will become visible. By that point, the system will no longer be able to rely on delay as a strategy. The mechanisms that were used to maintain stability, extending loans, deferring repossessions, and masking credit risk, will no longer be effective. And when that shift happens, the transition from hidden stress to visible breakdown will be rapid. Because what is unfolding here is not a temporary disruption. It is the result of structural decisions that have compounded over time, creating a situation where the system is no longer able to absorb the consequences of its own behavior. And as those consequences continue to surface, one thing becomes increasingly clear. The pressure that has been building is still being released, and the most severe phase has yet to fully arrive.